How do you know a property is primed for growth, and what are the factors you look out for? Look, I'm actually a contrarian investor. So when I look at assessing a deal or running through numbers, I'm looking at many different variables. There's three things I've always talked about, which is below market value, upside for capital growth, and a strong cash flow. So the property must have those three things before I look at it. But ultimately, there's a few things that I look at for growth. So some markets, like most people look at property deals, and I think I've probably spoken, to the community members, at least 10,000 people over the last decade that I've spoken to, just in map sessions that we've done, like myself, in the business. And from chatting with investors, like a lot of people say, I'm looking at buying in this area because the property market has gone up by 10% each year for the last few years, or I want to buy in a market which is guaranteed to have growth because it's had growth for a very long time. And a lot of people look at growth from different aspects, and I'm a contrarian investor, so I see things very differently. When I'm looking at properties and assessing them for deals, I'm actually scared when I see a market that's gone up so consistently. The reason being is that the upside potential has been already had from the other party. The counterparty risk and the downside risk from me buying that property at the heightened new high, the property's never been at that value beforehand. So there's a good chance for it to go down, but it's got price exploration to go up to the new levels. How much higher can it go? So when I'm looking at properties, I'm not looking at the existing growth that it's had, and sometimes I'm looking at growth which has been negative and looking at that as a positive. So what I mean by that is, if we look at the Sydney property market, a lot of people will think, it's 2021, and we'll look back to 2020 or 2019 or 2018 or 2015 or whatever. I'm going all the way back decades ago. When I first started looking at property, it was 1998. It was last millennium, actually. Some of my listeners weren't even born then. But wow, I feel old. But looking at property prices back in 1998 and 2000 and 2003, we had a big property boom in Sydney, for example, which peaked in 2003. And let's just use a property out in Western Sydney. House prices in Western Sydney hit around the $300,000 mark in 2003. And the market went backwards from 2003 to about 2007 when the GFC came through. Interest rates had hit to about 9% interest rate. And the house prices hit at a bottom. It was a very good time because when the GFC came through, we saw lots of money creation, a lot of stimulus packages, and a lot of currency creation, and the cost of money became very cheap, and interest rates went down by about 50%. What happened after the interest rates dropped? House prices went up. So in the years coming after 2008, 2009, 2010, the market caught back up to where it was back in 2003. And then from about 2010 to about 2015 in Sydney, the market doubled. And a lot of people felt like they were, superstars, the best investor in the world, all this sort of stuff. But reality is that these the properties had just gone up, and doubled from a 5-year period. People looked at it and was like, that's the best property market, we must buy there. At the same token, going back in 2007, 2008, 2009, similar investors were like, Nathan, that market has a lot of risk attached to it. The market used to be 300, now it's 200. It could just keep falling. I liked buying properties when the market was 200,000 because I saw that idiots had paid $300,000 beforehand. For the market to recover and get back to where it was, 10 years had passed without any growth. But different factors that had occurred is that interest rates had halved, a lot of immigration had occurred, there wasn't enough building in the market, etc. And we had seen a pent-up of demand. So there was a lot more demand, the cost of money was almost half the amount, and the property had not moved for 10 years. I saw that as a great opportunity for the boom to happen in 2010. So I called the market before it happened, and I called the market in 2016, 2017, when I thought the Sydney market was at a peak. And you can sort of see the trend lines as they occur, but most people look at, people were coming to me and say, Nathan, should we buy in Bitcoin when Bitcoin was $80,000? I'm like, no, you should have bought Bitcoin when it was $2,000. You should have bought Bitcoin when it shit itself a couple of months ago and it went down to 40 grand or 30 grand. People get caught up in FOMO and they get caught up in the hype and they want to buy things on the way up, but they don't want to look at things on the way down. And, that's when I'm looking for areas that are primed for growth and I'm looking for upside potential. I'm looking at, many other factors. I'm not just looking at, of the charts that it's gone up 10% last year and 10% the year beforehand and 10% the year before that, it must be a great buy. I'm assessing the risk on what will happen if the market collapses or falls down or whatever the case may be. And, the downside risk is one side of the equation, but the other side of it is can the market support higher prices? I'm looking in areas in Australia, in capital cities, where we can pick up properties for still under $200,000 in capital cities, which are renting out for $300 a week. These things are positive cash flow, and in the interest cost on a house at $200,000, 200 grand at 3% interest, that's $6,000 a year. That's about $120 per week in interest rates. It's very affordable for anybody to be able to pay $120 a week to put a roof over their head. Centrelink could pay for that now because the cost of ownership is so cheap. It's funny to think that $1 million mortgage, I remember as a kid growing up, everyone thought a millionaire was a lot of money. Everybody's got $1 million worth of debt. And, most people with $1 million worth of debt don't even have a house. So, looking at the market today, $1 million doesn't buy you much. And $1 million loan would be at, 2 or 3% interest rate. 3% on $1 million is 30 grand a year, or $600 per week worth of interest repayments. So, they're just rough numbers that I calculated quickly as I was saying this. But, the cost of money is very cheap, and the upside in some of these areas are so significant. It's understanding how the currencies work, and it's understanding what the debt to incomes are like in the area. It's a lot of factors. So for me, it's not just two-dimensional, it's multi-dimensional when doing deals.